How's everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. You may have heard that in the U.S. economy, we have this little thing called income equality, and we have kind of a problem with this. Today, we're going to be looking at two articles from the Wall Street Journal, which basically paints not a great picture for the U.S. economy. We are a lot of people would say we are a consumption-based economy. When you calculate GDP, consumption by consumers going out and buying things at the store, that is basically the driving force of our GDP. It's a consumption-based economy. When you look at what consumers buy, what businesses buy, we need that to keep going. Now, what's interesting here is that it looks like the American economy is continuing to rely more and more on the ultra wealthy in order to drive the consumption. And that's really the point of what we're going to be looking at here today. So let's bring in the first article here today. And this is called "The U.S. Economy Depends More Than Ever on Rich People." The highest earning 10% of Americans have increased their spending far beyond inflation. Everyone else hasn't. So many Americans are pinching pennies, exhausted by high prices and stubborn inflation. The well-off are spending with abandon. The top 10% of earners, household making $250,000 a year or more, are splurging on everything from vacations to designer handbags, buoyed by big gains in stocks, real estate, and other assets, otherwise known as asset price increase. Those consumers now account for 49.7% of all spending, a record in data going back to 1989, according to an analysis by Moody's Analytics. 3 decades ago, they accounted for about 36%. All this means that economic growth is unusually reliant on rich Americans continuing to shell out. Mark Zandi, chief economist at Moody's Analytics, estimated that spending by the top 10% alone accounts for almost 1/3 of gross domestic product. Between September of 2023 and September of 2024, the high earners increased their spending by 12%. Spending by working class and middle class households, meanwhile, dropped over the same period. And now here's a very interesting chart that we have here. And this is called shared of spending by income groups. So the lowest 20% of earners, 20 to 40%. And then you kind of get in the middle here, 40 to 60%, 60 to 80%. And then 80 to 90%, starting to go up here. And now you can see top 10% of earners now account for half of all spending. I mean, that's crazy. The finances of the well-to-do have never been better. Their spending never stronger, and the economy never more dependent on that group, said Zandi, who oversees the analysis, which was based on data from the Federal Reserve. The analysis runs through the third quarter of 2024 because that is the most recent data available. Taken together, well-off people has increased their spending far beyond inflation, while everyone else hasn't. The bottom 80% of earners spent 25% more than they did 4 years earlier, barely outpacing price increases of 21% over that period. The top 10% spent 58% more. A stock market sell-off or decline in home values that rattles the confidence of the top 10% and causes them to cut back would have a significant effect on the economy. Consumer sentiment is starting to slide overall, including for the wealthiest third of consumers, thanks in part to tariff threats. The buying power of the richest Americans, who Zandi said tend to be older and more educated, stems in part from the swelling values of homes and the stock market over the past several years. While rising asset prices are extolled as a sign of a good economy, they also are widening the gap between those who own property and stocks and those who don't. Vivek Trivedi, 38 years old, saved up during the epidemic. And in 2022 and 2023, he bought 3 investment properties in the Indianapolis area where he lives. His own housing costs are stable because he locked in a sub 3% mortgage on his primary home when he refinanced while interest rates were low during the pandemic. He and his wife, Purva Trivedi, both work in the pharmaceutical industry. They earn more than $350,000 a year combined, about 45% more than before the pandemic. They have 2 small children and support their parents who live with them. We've made some strategic moves in our own careers and also in investment portfolios. We haven't really had to cut back. Vivek Trivedi took up road cycling and bought a $3,000 bike. The couple noticed their grocery bill rising, but agreed that buying organic products was too important to them to give up. This year, they are budgeting about $10,000 to $15,000 for travel, including a potential trip to their native India. During the pandemic, Americans across the spectrum saved at record levels. They spent less because they were stuck at home and received extra money from the government's various stimulus measures. By early 2022, households socked away an extra $2.6 trillion. Then inflation struck. The prices rose sharply. Most Americans turned to their extra savings to keep up with their rising bills, but the top 10% of earners kept most of what they had saved up. Affluent people also found themselves with assets such as stocks that suddenly were worth far more. The net worth of the top 20% of earners has risen by more than 35 trillion, or 45% since the end of 2019, according to the Federal Reserve data. Net worth grew at a similar rate for everyone else, but it translated to a lot less money, an increase of 14 trillion for the bottom 80%. So, and then here's another nice chart here. So cumulative access savings by income. So you can see top 10% of earners, 1.3 trillion. And then we had the peak here. You had the pandemic. People got a bunch of money. They saved money because they weren't going out and doing a lot of stuff. So we saw their savings spike up, but then all that stimulus wore off. Inflation kicked in massively, and then people had to drain their savings. And now the other 90% of earners are sitting at about 291 billion. Because obviously the people at the top, they have a lot more access, they have excess money, right? They have excess disposable income. They don't need to tap into their savings to continue to pay their bills. Tom Schoaf, a 61-year-old test pilot who lives in Alamogordo, I'm probably not saying that right, New Mexico, estimates that his net worth is up about 40% since the pandemic. Nearly all his assets, from a ranch in Wyoming to the stock he holds in his retirement accounts, are worth much more now. His wife, Christy, is an occupational therapist. Together, they earn about $500,000 a year. They recently started giving an annual gift under the gift tax limit, which is $19,000 to each of their 2 adult sons. I had several relatives die during COVID. I thought, why are we waiting? He said the couple have more than $1 million set aside to buy a new home when they retire in a few years. He bought a plane before the pandemic. A rising net worth certainly gives you confidence to do more things, he says. Bank of America found that credit and debit card spending by their richest third of customers was growing faster than spending by the lowest earning third. Well, kind of like no duh. Certain categories of spending were especially robust. The top 5% of households spent more than 10% more on luxury goods abroad compared with the year earlier. They're going to Paris and loading up on their suitcases with luxury bags and shoes and clothes. Delta Airlines chief executive Ed Bastian last month said he expected a strong appetite for high-end travel to fuel profit this year. The airline's sales of premium tickets rose 8%. Revenue from sales of main cabin tickets rose 2%. Royal Caribbean said it had the best 5-week booking period in its history in recent months and announced the launch of European river cruises, which are popular with a higher-end set. It's an extra bifurcation between those companies and others that cater to poorer customers, said JP Morgan Chase analyst Matthew Boss. Big Lots filed for bankruptcy last fall. Kohl's and Family Dollar are closing stores. They're all battling for fewer dollars, Boss said. Barbara Pierce, 57, runs a membership group, Women with Capital, focused on impact investing and philanthropy. Rising grocery prices have been a topic of discussion, even among the wealthy women who participate. Pierce, who lives in Marin County, California, has been scaling back on takeout meals because of rising prices. I don't want to have a $15 sandwich. Pierce and her husband together bring in about $300,000 a year, largely from investment income. The couple and their teenage son went on a 3-week safari to Africa in July. They cost about $35,000. We're spending a lot of money doing things that we really want to be able to do while our son is living at home with us, Pierce said. We feel like the time is now. And she's planning on making another big purchase or whatever here in a few months. So, okay. I find this disturbing. Like, this is not a healthy economy. This is certainly not a healthy American economy when this kind of stuff is going on. And then I want to share, I don't want to make everybody too mad here, and then we had this article, was the second article, and this is called Meet the World's 24 Super Billionaires. The ultra rich are growing in numbers and changing wealth as we know it. So in 1987, Forbes published its first billionaires list featuring 140 individuals whose combined wealth totaled 295 billion. At the time, the richest person in the world was Japan's Yoshiaki Tatsusumi, a real estate tycoon worth 20 billion. Today, the world's richest person, Elon Musk, is worth 419 billion, roughly 21 times as much as Tatsusumi at his peak, and more than 2 million times as much as the median net worth of an American household, according to exclusive data from global wealth intelligence firm Altrata. As the ranks of global billionaires have swelled dramatically in recent years, a new category of ultra-rich has emerged, the super billionaire. Musk is one of just 24 people worldwide who qualify for that distinction, which is defined as individuals worth 50 billion or more. As of early February, those super billionaires' fortunes accounted for more than 16% of all billionaires' wealth, a dramatic increase from 4% in 2014, according to Altrata. Their combined net worth totaled 3.3 trillion, equivalent to the nominal GDP of France. And of those 24 people, 16 qualified as centibillionaires, meaning they have a net worth of at least 100 billion. The rise of the super billionaire has coincided with a significant leap in luxury markets across the world, including real estate, as these individuals cobble together massive portfolios of luxury homes around the globe. And, a lot of the usual suspects on here, obviously Elon Musk, Jeff Bezos, Bernard Arnault, Lawrence Ellison, Larry Ellison from Oracle, Mark Zuckerberg, Sergey Brin, Steve Ballmer, Warren Buffett, James Walton, Samuel Robert Walton of the Walmart family. And we could go on there, but experts say the data show how the ranks of the ultra rich have begun to pull away from the merely wealthy, and how a subset has been propelled to new heights. Billionaires have always obviously controlled significant amounts of wealth, but now you're talking about differences in the billionaire population themselves. It's quite staggering just how much the net worth of some of these people have grown. In major luxury real estate markets like New York, Miami, Palm Beach, Florida, Los Angeles, and Aspen, Colorado, new super tall towers and spec mansions have propped up gearing specifically to the billionaire set, and there has been an explosion of 9-figure home sales across the country. Each of the super billionaires on Altrata's list has a direct personal residential real estate portfolio of at least $100 million, and often far more, according to the company. Imberg said that the number is likely to be a significant underestimate in some cases, because real estate can often be held in a partner's name or owned by one of these billionaires' companies or holding companies. The world's super billionaire population is made up in large part by entrepreneurs who made their money in the tech sector, or whose industry was catapulted to new levels by technological advances. Of the top 10 richest individuals on the list, 6 fall into that category. Of the total 24 super billionaires, only 3 were female. Only 7 were headquartered outside of the United States. The rise of the super billionaire marks a transformation in the composition of the world's ultra wealthy, experts said. In the 19th and 20th centuries, the richest men were industrialists. John D. Rockefeller built Standard Oil into a monopoly. Andrew Carnegie dominated the steel industry, and Cornelius Vanderbilt amassed a fortune through railroads. Their wealth, while vast, was spread across industries that defined an era of physical infrastructure and manufacturing. Through Standard Oil, John D. Rockefeller became the world's first confirmed billionaire in 1916. During that period, a company's value accounted for physical assets like property and machinery, more so than the types of intellectual property and promise of future scale and earnings that push up values today. Okay, so the rest of the article basically just runs through these individuals or whatnot, but you hate to sit here and look at this and say, Houston, we have a problem. I think something is going to have to be addressed. Something's going to have to be done to address this disparity in wealth and income. I mean, when you have, and it's not just a United States problem. I mean, this is a global problem for the world. I mean, you can't have, 2% of the people in the world owning more money than 50% or 70% of the rest of the population. That income inequality just is it's not going to work. And history has taught us that when that happens, it generally leads to bad things. It generally leads to revolutions and all kinds of other stuff that we don't want to see. So what are the answers to that? I don't know. I'm not sure exactly what the answers are. I would say taxation would probably be the first place I would look. I think we probably need to start to consider some kind of billionaires tax. But like I said, I'm sure other people will propose other ideas and think of other things. But it's not great that the American economy is relying so much now on these wealthier individuals to basically drive the consumption in the economy. That's not good, and it won't last forever. As it says in the article, the top 1%, top 10%, the very wealthy, they're riding high right now because asset price inflation has been very good to them. Real estate values are up, stock values are up. If that changes and all of a sudden real estate values start to come down, stock market has a reset or a correction or a recession, whatever the case may be, then all of a sudden they may actually start to cut back their spending. And then what happens there? As they said, consumer sentiment has already started to shift downwards because that bottom 50% of the population here in the U.S., making up of the U.S. economy, is they're taking it on the chin right now. They're suffering with the high inflation and having to work multiple jobs and all the other things that they go through. So, but anyway, like I said, I thought this was interesting. Definitely more to come on this in the future as I continue to follow these trends and see how this plays into some of the economic indicators that we follow. But I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. Thanks, everybody, a lot. I'll see everyone again real soon.